For decades, there's been this one simple number that retirees have clung to. It's been the golden rule. But what if that rule is completely broken? Today, we're going to dive into why one of the most famous rules in personal finance is being totally rewritten for 2026. And look, that's not just me saying it. This is coming straight from the top, from leading financial analysts and researchers. This single sentence, it captures a massive shift in how we need to think about funding our retirement. It's a direct shot at a rule that's been the bedrock of financial planning for over 30 years. So, where did this rule even come from? Well, let's rewind to 1994. There was a financial advisor named Bill Bengen, and he set out to answer a simple question. What's a safe withdrawal rate that could survive even the worst market conditions imaginable? And the concept he came up with was, just beautifully simple. You take 4% of your total nest egg in year one of retirement. So if you've got $1 million, that's 40 grand. That's your new paycheck. Then the next year, you just give yourself a little raise based on inflation, and you keep doing that for 30 years. For a very long time, this was considered a nearly bulletproof plan. Right. But here's the thing. The world we're heading into in 2026 is not the world of 1994. The math that made the 4% rule work so well is now running into two massive economic headwinds that are forcing everybody to go back to the drawing board. The first big problem is that stock market valuations are, they're really, really high. Think of it this way. When you're buying into the market at a premium price relative to what companies are actually earning, the potential for future growth is just naturally lower. You're starting the marathon on top of a hill instead of at the bottom. Okay, and this slide, this is where it gets really stark. The CAPE ratio, it's a long-term way to measure if the market is cheap or expensive, is sitting at nearly 40. The historical average, it's under 18. That's not just a little high, it's more than double the average. It puts us in the 99th percentile of all historical data. That basically screams that future returns are going to be tougher to come by, making it way harder for a portfolio to support those old withdrawal rates. All right, so headwind number 2 is this weird thing economists are calling stagflation light. Now, this isn't the full-blown 1970s disaster, but it's this really sticky, annoying mix of kind of meh economic growth. We're talking around 2.2%, and inflation that just hangs around like a bad cold. Yeah, forecasts are putting that persistent inflation right around 3.5%. So why does this matter so much? Well, think about it. Your withdrawal amount is trying to stay level, but the price of everything, groceries, gas, healthcare, it's going up by 3.5% every single year. Your portfolio is on a treadmill that's constantly speeding up, and it puts a huge strain on your money. So if the old number is on shaky ground, what's the new magic number? Well, the folks at the research firm Morningstar, who do a super deep dive on this every single year, they have an answer for anyone looking to retire in 2026. And here it is, 3.9%. That's their new base case safe withdrawal rate. It's the highest starting rate a new retiree can take for a stable, inflation-adjusted income and still have a 90% chance of their money lasting for 30 years. It's a tiny change on paper, but it signals a major shift in the margin of safety that's needed today. Now, I know what you might be thinking. 0.1%? Seriously? Who cares? But look at what a difference that tiny little decimal makes. On $1 million portfolio, it's $1,000 a year. On a $2.5 million portfolio, that's $2,500 less in your first year alone. And remember, because all your future inflation adjustments are based on that lower starting number, the gap between the old rule and the new guideline just gets wider every single year. And this is where we get to the real heart of the matter. While 3.9% might be the new conservative benchmark, the real evolution in retirement thinking isn't about just finding a new static number. It's about moving to an entirely new strategy. The real takeaway for 2026 and beyond isn't a number, it's a concept, flexibility. Being rigid with your plan is the absolute enemy of a successful modern retirement. The future belongs to dynamic strategies that can actually adapt to what the market is doing. So, what does that actually look like? Well, instead of blindly taking out the same inflation-adjusted chunk of cash no matter what, a dynamic strategy connects your spending to how your investments are actually doing. So in a killer year, when your portfolio is up big, you might give yourself a little bonus. But if the market tanks, hey, maybe we skip the cost of living raise for that year. It's just about being smart and reacting to the real world. And here's the awesome part. If you're willing to be flexible, look at the potential payoff. Morningstar's research shows that if you can accept some variation in your annual income, you could potentially start with a withdrawal rate as high as 5.7%. That is a huge pay raise in retirement. The catch, of course, is that your income isn't going to be the exact same predictable number year after year.
Okay, so we've spent all this time talking about the fear of running out of money, right? But now the story takes this totally unexpected turn. Because when you look at what retirees are actually doing with their money, you find the problem is the exact opposite.
I mean, just look at this chart. It's kind of mind-blowing. You have the financial planners up here debating 4% versus 3.9%, and then you have reality, where the typical married retiree is only withdrawing about 2.1% from their accounts. That's not a gap, that's a canyon between financial theory and real-life human behavior. And the reason for this is, well, it's all psychological. People are so terrified of running out of money, especially if they don't have an old-school pension to fall back on, that they just don't spend it. They're essentially sacrificing their own quality of life, and in many cases just end up leaving a much bigger inheritance than they ever planned for. Okay, so where does that leave us? How do we take all of these pieces, the scary valuations, the sticky inflation, the psychology of spending, and build a plan that actually works for today?
All right, here's the new playbook. This is what it all boils down to. First, think of 3.9% as your starting point, your conservative base camp. It's not a law, it's a guideline. Second, if you can handle a little bit of change in your income from year to year, build in that flexibility. Use what they call guardrails, simple, preset rules like, if the market has a really bad year, I'll pause my inflation increase. This is what can unlock that higher income. Third, and this is huge, lock down your essential expenses. Make sure your mortgage, food, and healthcare are covered by guaranteed income, like Social Security. That gives you the psychological freedom to actually spend from the rest of your portfolio. Next, keep an eye on those market valuations we talked about. And last, always remember to think in terms of net. It's not what you withdraw that counts, it's what you actually get to keep after fees and taxes.
So at the end of the day, this isn't about one number versus another. It's about moving from a rigid, outdated rule to a smart, flexible strategy. The world has changed dramatically. The only question left is your retirement plan built for the reality of 2026, or is it still stuck back in 1994?